Hey guys, Professor Dalton back with the second part of Intro to Financial Accounting. Today we're going to get into some of the more detailed descriptions of how to actually post and journalize some entries. So let's get going. And when we look at analyzing and recording transactions, what we're looking at is determining whether we are going to increase or decrease an account. And of course, that's going to depend on the type of account. Accountants are record keepers. They're bookkeepers, right? We've heard that term. We are keeping the records of a company. And this is why, for example, expenses go up. Your expenses don't literally decrease, right? You're paying expenses and your cash is decreasing. But if we want to, let's say, keep a record of how much we pay in power bill across a year, right? We've got cash going out, but if we were to write that down, we would write down an increase in cost, right? So expenses are booked as an increase. It'll make more sense in a little bit, but think about, again, an expense being anti-equity, being against equity, being a negative to equity. But for the most part, again, we are always increasing things. That's why we have this great, awesome rule of debit and credit. It allows us to increase things while decreasing other things that maybe not logically we could kind of put together. So we're going to look at analyzing and recording transactions. We're going to post these transactions into a journal, and then we'll look at an example of a general ledger, which is basically all of our books together. So you've got your checking account, which is pretty much like a company's cash account, right? You've got things coming in, things going out. Companies have expenses like rent and salaries that they want to keep record of. They want to keep up with their total cost. So we're going to record keep. We're going to keep up with these total costs. And our process of record keeping is called journalizing. When we get source documents, we will recognize that a transaction needs to take place or it has already taken place, and we will journalize that transaction, the effect of which will affect the accounts that we are journalizing against, right? Every transaction is going to affect at least two accounts. So like when I said earlier, we pay rent expense. We're paying that with cash. So cash is going out, cash is going to decrease. Rent expense technically is going to increase, but it works to decrease equities. So if you remember my accounting equation, assets equals liabilities plus equity, I've got an asset, cash goes down, equals liabilities plus owner's equity, equity is going down as well, right? So assets go down, equity goes down when I pay rent. What if I pay cash for a piece of inventory, let's say an item that I plan to use in my business? These are only affecting things on the asset side. Cash, an asset, is going down, but let's say equipment, another asset, is going to go up. So we're always going to affect at least two accounts, and this is what is going to allow my accounting system to balance. Remember, assets have to always equal liabilities plus equities. If something on this side of the equal sign goes up, something on this side of the equal sign has to go up. Likewise for down, right? If the assets go down, a liability or an equity has to go down as well. If I'm only affecting one side of the equal sign, they have to work in reverse. One asset goes down, another asset goes up. But always remember, my equation will always balance. If you're ever concerned as to whether or not you have made an entry correctly, just see if assets still equal liabilities plus equities. If they don't, you did it wrong. If they do, you probably got it right. So my 4 steps to recording a transaction. I need to identify what is going on. What happened? What types of accounts are being affected? That's the analyze portion of it. I'm analyzing a transaction. I need to identify that a transaction has occurred. I need to analyze this transaction to figure out what accounts need to be increased or decreased. I can then record that increase or decrease into these accounts, and then I can post the transaction into the general ledger, kind of making it I'm adding it into my journal, right? My daily happenings of the business. So we've got kind of a mock starter company, if you will, that is going to allow us to follow this idea of processing transactions and posting these amounts into the accounts that are being affected. So really we can just go through this. This is maybe 11 transactions I think I put in here, just to give us an idea of how this whole system of debit and credit work. And again, kind of that mysterious negative thing, which we'll get to in a second. But notice this is kind of my first entry, if you will, that a new owner would do when he's starting up a business. Investment by owner of $40,000 in cash. You have to give the business money, right? You have to fund the business. Businesses are separate legal entities from their owners. Therefore, when we begin this business, we need to almost kind of fund the business. Now, again, that money is owed back to the owner, right? This is the owner's investment. This is owner's equity. This is how much equity the owner has invested into the business. And a little bit later, we'll come to call this paid in capital. This is the owner, again, paying into the business, giving the business capital so that it can then perform as a business. But the way this transaction works is we identify the transaction, investment by owner, $40,000 in cash. Again, recognize that I always affect at least two accounts. So when I say investment by owner $40,000 in cash, cash is right there, right? I know cash is being affected, and I know that my business is increasing $40,000 in cash. Cash as an asset is going to go up by $40,000. And my capital, my owner's investment, my owner's equity, it is also going to go up by $40,000. So assets, now my only asset is cash at $40,000. Liabilities plus equities, my only equity is owner's equity, and it's $40,000. Both sides of the equal sign has $40,000 increasing. 40,000 equals 40,000. I balance, right? So we're only through step 2 though. Let's look at how to record this transaction. When you record a transaction, you're always going to start with the date, and you're always going to start with the debit entry first. This is very important. You always start with the debit entry first. This really is just for readability. It allows these records to become easily readable so that you always kind of have this debit first, and then the indentation, and then the credit entry. But notice here, I've got cash being debited for $40,000. This debit to cash, because cash is an asset, this is an increase to cash. Notice under capital owner, because this is an equity account, it increases with a credit entry. So I've got debit increasing $40,000, an asset. I've got a credit entry of $40,000 increasing an owner's equity. Assets equals liabilities plus equities. And as I can see here, of course, my equation still balances. Now what this looks like when we actually post these transactions, we're going to post each transaction into its own account so that we can get a balance of what's going on in this account. Right now, again, we only have this one entry for cash for $40,000. Again, this is my T account, and it has $40,000 in the debit side. My capital owner, my owner's equity account, has $40,000 in the credit side. And this little one here is just to kind of let you know that this is, and I've put all these in order just, on purpose so that we have a reference number. But you'll notice that this one is going to match the date, and we'll keep that going throughout the rest of this example so that we'll follow the example a little better. In our second transaction, we've identified, it looks like I have purchased supplies for $3,500 using cash. This is an asset for asset exchange. You'll notice under my analysis, my assets, cash, I've got that little negative there, negative $3,500. Cash is going down by $3,500. Supplies is going up by $3,500. Notice everything happens on one side of the equal sign. Therefore, my transaction, my books, they still balance. I've got $3,500 worth of one asset going down, but I have $3,500 worth of another asset going up. So what is my balance right now? It's still $40,000, right? I just exchanged the $3,500 in cash for $3,500 worth of supplies. Now I know what you're thinking. You're going to use those supplies, right? But you haven't yet. You just walked, let's say you just walked back through the door. You took $3,500 to Staples and you bought a bunch of staples. And you just walked right back through the door holding all these staples. You still have $3,500 worth of an asset. You haven't used them yet. When we look at recording this transaction, again, I've got my date. I'm using January 2nd, so we have this reference number. But again, you can see here how I've got supplies comes first because it is a debit entry to increase the asset supplies. I'm increasing the asset by $3,500. This asset account supplies is going to increase by $3,500. The supplies account now has $3,500 in it, and there it will stay until I recognize the use of those supplies, and we'll see that a little bit later. But for now, look down here at my cash. Cash has a credit for $3,500. Now notice what you don't see here. Notice what you don't see up here. This is a credit entry to cash. It's not a negative entry to cash. I mean, it is because it's a credit to cash. But my point here is we are not doing a negative number. Notice this is a decrease in cash, but there is no negative number. Sorry about that. There's no negative here. There is no obvious decrease to cash maybe, other than the fact that it is a credit to cash. Look up here at our posting. When we actually post this amount to our T account, we've got our debit entry of cash of $40,000. We now have a credit entry to cash of $3,500. So how much is left in the cash account as of this moment? We still have $40,000 worth of assets, but now instead of having $40,000 in cash, we have what, $36,500 in cash, with the remaining $3,500 of assets in supply. So this company, now that they've got some cash in their cash account and they've got some supplies, well, they need some equipment as well, right? We need to, well, we got to spend money to make money. We need some equipment so that we can build whatever it is our business is going to build. So the company has decided that it needs whatever this is. I don't know. There's no context in here, and it really doesn't matter, right? We're accountants. We don't care about the context. We just need numbers. We need these accounts. We need to know what happened. Just tell us. So somebody came up and they said, hey, listen, I need a $22,000 piece of equipment. I think I'll go buy it. And as accountants, we're like, sure, boss, go for it. Do what you need to do. We give our boss, let's say, $22,000 in cash, and he comes back with a $22,000 piece of equipment. Just like before, this is an asset for asset exchange. We have given someone $22,000. They gave us back a piece of equipment. This equipment is going to be an asset. It is something that we are going to use as part of our business. So again, just like we saw before in our supplies transaction, cash account goes down, equipment goes up, but both things are on the same side of the equal sign. So in essence, nothing happened. We simply traded an asset for another asset. But as we can see down here when we record it, again, we're not negative to cash. We are crediting cash. And again, this does work to reduce the cash balance. We started with $40,000. We took out $3,500 for supplies. We've now taken out another $22,000 for equipment. Notice in my T accounts when I post these transactions, cash now shows again the $40,000 increase, the $3,500 and the $22,000 decrease. Equipment is now showing the $22,000 increase in its balance. Again, the only things that were affected were on this side, the asset side of the equal sign. The transaction or the formula really doesn't change. So on the 4th, I've decided for whatever reason, I need even more supplies. So when I identify this transaction, company purchases $4,600 of supplies on account. That's new. On account. Anytime you see the words on account, it's going to mean accounts something, okay? In this situation, company purchases $4,600 of supplies on account. Basically what this is saying is that we have bought $4,600 worth of supplies and we told the company to send us a bill, we'll pay it later. It's perfectly fine, of course. Businesses do this all the time. That's pretty much how businesses operate. But notice what we are doing this time. Before, we took cash, minus cash, negative cash, and brought back supplies, positive supplies. Everything happened on this side of the equal sign. So one thing went down, cash, another thing went up, supplies. In this example, though, we are giving an IOU, right? We're telling this other party that we will pay them later. This becomes an accounts payable, and I abbreviated it here, but it is accounts payable, AP. You will see this abbreviated this way, but again, accounts payable. So what we have here in this transaction, to analyze it, I've got assets of supplies increasing by $4,600. I have brought home, let's say, $4,600 worth of supplies, but I told the company to bill me later. So what ends up happening is my supplies account increases, my payable, my liability, also increases, right? This person gave me $4,600 worth of supplies. I possess $4,600 worth of supplies. I bring it back to my place of business and plop it down on the table, and there we have it, $4,600 worth of supplies, right? Worth of an asset. But I also brought home a liability. I brought home the fact that I now owe this person $4,600. I have to pay that later, right? I owe it, it's increased. My liabilities, the amount that I owe people, has increased. When I record this transaction, again, notice on the 4th, and I've got my little signifiers here, if you will. Supplies, again, gets the debit entry for $4,600, and that is an increase to the asset supplies because it is a debit entry. Debit entries increase assets. Notice my accounts payable is a liability. Credits increase liabilities. So two things increase here, right? And that's totally fine because they're on opposite sides of the equal sign. I have brought home $4,600 worth of supplies, but I now owe $4,600 to somebody else. My supplies, you can see, I had $3,500 to begin with. I now have another $4,600. I owe $4,600 to the outside party that allowed me to purchase these supplies on account. Hey, we're going to start making some money now. That's good. All right, so in this transaction, we identify that we have provided services and we immediately collect cash for $5,200. And again, we don't have to immediately collect cash, right? We can send a bill out. Businesses do that all the time. But we still earn revenue, and we'll see how this is different in a little bit. But for right now, let's just kind of take this as it is. Provide services and immediately collect cash of $5,200. Now, one thing I haven't really mentioned is the fact that we can, well, basically we can guess, or we're told even, parts of our answer ahead of time. In the identification of the transaction, this is very basic. This is very basic language that doesn't really tell us a whole lot, right? Provide services and immediately collect cash. $5,200. Now notice, that's all the information we need to complete this transaction to show this debit and credit entry. Provided services, immediately collect cash of $5,200. And I know all of you guys are saying this right now. You're screaming at the monitor, right? Cash increases with a debit entry, and you increase cash with a debit entry of $5,200. It's that easy. Half of the problem is exactly that easy because it tells me right here, collect cash $5,200. I know how to collect cash now, right? I've done it a few times. So the collection of cash, the increase in cash, is a debit entry. Now I know, because I'm in an accounting class, I have to credit something. And I have to credit it for $5,200. I've already got my debit entry to cash for $5,200. I know I have to credit something for $5,200. Well, I'm crediting service revenue. I'm earning revenue based on the service I have provided, and I'm earning revenue of $5,200. So when I post this transaction, I don't have all of my cash listings on here, but of course every transaction that has affected cash up until this point is going to be in this list. And we can always determine a up-to-date, accurate cash balance by looking at these debits and credits, the incomings and outgoings of cash. And we can see down here service revenue has a credit entry of $5,200, again signifying the increase, the fact that I have earned revenue during this time period. But again, keep in mind that I'm not always going to get cash immediately after performing a service. A lot of times the client will say, send me a bill, I'll pay it. Okay, that's fine with me. The IOU, the accounts receivable, is just as good as cash. Well, maybe not just as good, but it's still an asset. Someone owing me cash is the same as me having cash, according to my accounting books. All right, so on the 6th, weird day to pay rent, but why not? Maybe it's just a day late. Maybe we're supposed to pay it on the 5th. I don't know. I don't write any context into these things, but I've got an identify my transaction that the company has paid $1,500 for rent. When I analyze this transaction, I recognize, and again, this doesn't say cash, right? But if I paid $1,500 for rent, well, yeah, I mean, I obviously paid cash. So when I analyze this transaction, I've got it my asset, cash. Again, it's going down. It is being decreased by $1,500. How do I decrease cash? That's right, I credit it. Now, when I pay this cash, of course, cash is going down with its credit entry. Notice rent expense. I do have this negative here, but that's only really to signify that it is a negative to owner's equity. When I'm actually booking this rent expense, recognize again that this is an expense. Expense accounts have normal debit balances. Therefore, expense accounts increase with a debit entry. So this to me is probably maybe the most confusing part about the intro to accounting, is that technically what I have going on here is I've got a decrease to cash, but an increase to rent expense. That is to say that I'm always increasing this rent expense account. However, because expenses are, let's say, anti-equity, the increase in rent expense means a decrease to owner's equity as a whole. So this equation balances, even though it's technically a decrease to cash and an increase to rent expense, because the increase to rent expense is a decrease to owner's equity. So when I look at my transaction down here, when I've recorded the transaction, I'm debiting rent expense to increase rent expense, but decrease owner's equity as a whole. Cash, of course, is being decreased by $1,500. And again, we can see in the T accounts here where my cash is a little bit more filled out than it was before, my entries with their reference numbers. And I can see again here, the $1,500 in cash is going out. It is being credited to cash, showing a decrease to cash for $1,500. And again, this rent expense, even though it is an equity account, it is an expense, and it is increasing with this $1,500 entry. All right, so on the 7th, I have decided to pay my employees a salary. Notice under Identify, company paid $700 to employees for salary. I'm paying my employees in cash. Cash is going out by $700. Salary expense, although it is increasing, it is a decrease to owner's equity. The same thing for rent expense. So on the 7th, I am debiting salary expense to show the increase in this expense. Cash, of course, is decreasing with this credit entry. When I post these amounts, these numbers into these accounts, I can see again cash going out of $700. Salary expense, technically it's going up, right, by $700, but the net effect is it reduces owner's equity by $700. This side of the equal sign goes down by 700. This side of the equal sign goes down by 700. My equation still balances. All right, on the 8th, Provide services and bills client, $1,500 on account. Again, notice that on account is in there. This time we've provided services and billed our client. This means that this on account is something that I expect to receive. Okay? So even though I'm not getting paid cash, I am getting a promise to receive cash later. This works the same way that we saw in the other service revenue example, except in this case, we're not getting cash, we're getting a promise to get cash later. So the way that this will work is when we analyze the transaction, I've got a receivable, an asset, accounts receivable, something that someone owes me. It is increasing by $1,500. Whoever I did the service for said, I'll pay you later. That is a receivable of an asset. I expect to receive cash later. I expect to receive $1,500 in cash later for services that I have already performed. So the point here is, if you guys will remember my revenue recognition principle, I recognize revenue now on the 8th as earned revenue, even though I do not have cash yet. Service revenue of $1,500 gets booked right here on January 8th. And do you remember why that is? Because of the matching principle. I probably also used assets in order to earn this revenue, and the two need to match. I need to be able to put the expenses incurred with the revenue earned so that I can determine if I made a profit or not. When I post these amounts, we can see under accounts receivable, which again is an asset, increases with this debit entry of $1,500. My service revenue, which is a revenue account, it increases owner's equity, so it has credit entries of again the $5,200 that I did before and got that cash, and then now the $1,500 that I am performing on account. It is still considered revenue, even though I am not going to receive it yet. But then the very next day, the person that I completed these services for decides to pay me. I don't know, maybe they didn't bring their checkbook. It doesn't really matter, does it? Again, context, don't really care. So when I identify this transaction, the company has collected cash from the service that I performed, again, on 1/8, just the day before. So on the 9th, I am going to collect cash. Just like before, I'm exchanging an asset for an asset. This accounts receivable represents the $1,500 that this person owes me. When this person brings me $1,500 in cash, well, they no longer owe me $1,500, right? This $1,500 asset and accounts receivable is going to convert to an asset of cash of $1,500. But again, because everything affects just one side of the equal sign, my transaction, my equation, it's still going to balance. Everything is going to, well, the net effect is nothing. When I record this transaction, I'm recording again the date of the 9th, the receipt of this cash of $1,500, which again is going to increase my cash balance by $1,500. This is a debit to cash, increasing cash by $1,500. This accounts receivable entry, credit to the asset, is going to be a negative to the asset. So notice what we have here. Under accounts receivable, on the 8th, I recorded an increase of $1,500 because as of the 8th, I was owed $1,500. On the 9th, I got paid that $1,500. So on the 8th, I had a debit balance of $1,500. On the 9th, I posted a credit for $1,500 into accounts receivable. Notice I now have a zero balance in accounts receivable. But that zero balance, by the way, is going to be on the debit side because you will never have a credit balance in accounts receivable. The lowest accounts receivable can get is 0. And again, that 0 is going to be on the debit side. Basically, just get used to it. Accounts receivable has a debit balance. And that's another good point. If you ever end up with a credit balance in something like accounts receivable or cash, recognize you cannot possibly possess negative cash. You can be in debt to people, right? That's what accounts payable is. But literally, physically possessing negative cash isn't possible. So assets will always have a debit balance, Even if that balance is 0, like we see here, it's still debit side. All right, so on the 10th, I can see that the company is paying $2,100 toward the payable of supplies that I purchased on the 4th. What this is saying is that, remember back when on January 4th I purchased supplies. I purchased supplies of $4,600, right? On the 4th, $4,600, accounts payable, probably what that is. I'm an accountant, I don't really need to know. But I had $4,600 in accounts payable. I have paid a portion of that. Under Identify, company pays $2,100 toward the payable for the supplies that were purchased on the 4th. I purchased $4,600 worth of supplies. I owe $4,600 to this company. I'm going to pay them $2,100. So again, when I analyze my transaction, I can see that I've got cash decreasing of $2,100 equals liabilities, accounts payable, decrease by $2,100. Both sides of the equal sign balance. Both are a negative $2,100. When I actually journalize this transaction, I'm going to recognize that accounts payable, being a liability, gets debited the $2,100 to make it go down. What's happening here is I owed this company $4,600. Again, my liability accounts payable, credit side. On the 10th, now, when I'm paying this company their $2,100, I am going to debit their accounts payable. That is to say, what I owe this company is now going to decrease by $2,100. When I entered into this agreement to pay them $4,600, I posted a $4,600 credit entry to accounts payable. Now, when I'm paying this part of this bill on the 10th, I am reducing this liability by $2,100. The balance, of course, is $2,500, and this is how much I still owe to the company. Notice again, this is a credit balance because this is a liability. Liabilities always have a credit balance. A credit is what increases a liability. Notice here, this credit of $4,600 increased the liability by $4,600. This debit decreased the liability by $2,100 to give us $2,500 credit side balance. And again, just like before, you will never have a debit side balance in accounts payable. It would then become an accounts receivable, right? Worst case, you overpaid payables and you paid more than you owed. Well, now they just owe you more, right? They owe you back. So again, you're never going to have a debit balance in accounts payable. You're never going to have a credit balance in, well, any asset, right? Because you cannot possess negative assets. All right, and finally on the 11th, my owner has requested $500 for personal use. My owner needs a paycheck. My owner needs what we'll come to find are called dividends. But for now, we're keeping everything pretty basic. We're just going to call it an owner withdrawal, all right? So when we look at our analyzing this transaction, what happened? Owner requests $500 for personal use. Owner says, hey, I need $500. We give him $500 out of the company's cash account. Where does this come from? It comes from the owner's withdrawal. It comes from the owner's equity being removed from the company. And again, he's our owner. He's more than welcome to do that, right? We do this in corporate business as well, except we call it dividends. We'll get to that a little bit later. But we can see here under the record section on the date, 1/11, owner withdrawal is debited for $500. Now again, this debit represents an increase to owner's draw, an increase to dividends, which is what we're eventually going to start calling it. This debit entry is an increase to dividends, but it is a decrease to owner's equity. Of course, cash being credited for $500, that's a very obvious decrease to cash, right? When I look over here at my postings, I can see everything that has happened to cash up until this point, this $500 being removed from cash. The owner, of course, the owner draw has a normal debit balance, and it is being increased by 500, but this increase in 500 represents a decrease to owner's equity as a whole. And on this slide, we can see everything that we have done up until this point. I can see all of my cash transactions along with their reference numbers. 159 in the debit side, 2, 3, 6, 7, 10, and 11 all on the credit side. But again, because cash is an asset, and that's what that little A means there, cash has a normal debit balance. It will always have a debit balance because, again, you cannot possess negative cash. Cash now has a debit balance of $16,400. Again, it is an asset. It has $16,400. My accounts receivable, if you'll remember, I was told they would pay me, and then they paid me. So now I have 0 in accounts receivable because I have received that $1,500 in cash. Right there. Supplies, if you'll remember, I got $3,500 and then I bought another $4,600 on credit for a total of $8,100. And as of now, I haven't really updated my supplies account. Keep in mind, this is probably different. By the 11th day of the month, I have probably used a few supplies, but they're not reflected in this transaction chart yet. Equipment, remember, I purchased for $22,000. Again, equipment is an asset. It will have a debit balance. I have purchased $22,000, so equipment has a $22,000 debit balance. Now what I want to do is I want to add all these things together. My $16,400, the $8,100 in supplies, and the $22,000 in equipment should give me $46,500 in total assets. Now my liabilities, accounts payable, remember my $4,600 incurred, I paid $21, I still owe $2,500. I increased my equity service revenue twice, once on the 5th for $5,200, again on the 8th for $15,000 for a total of $6,700. And I also increased capital because my owner paid in capital of $40,000. And again, what I've kind of I've set these increases to equity right here. This is an increase, or liabilities and equities. This is an increase to liabilities and equities. This is an increase. This is an increase. Notice down here, these are my decreases. My owner drawing, my dividends, and my expenses. These work to reduce owner's equity. So when my owner took $1,500, or sorry, when my owner took $500 out, he reduced owner's equity by $500. When I paid rent for $1,500, I reduced owner's equity by $1,500. When I paid salaries of $700, I reduced owner's equity by $700. So, if we take my $40,000 in equity, my $6,700 in revenues, my $2,500 in my liability, and I subtract $500 in owner drawing, $1,500 in rent expense, and this $700 in salary expense, I should get the same $46,500 that I got for assets. If I don't, I am not going to submit this as being a correct homework problem, right? I can recognize right here, right now, that the problem, whatever I've done, is wrong. Something I did is incorrect. Always perform this quick check. When you're doing your homeworks, when you're doing tests, always make sure assets equal liabilities plus equities. If it does, you probably did everything correct. If it doesn't, you definitely did something wrong. Next time we're going to look at adjusting entries. And what this is I'll go back a slide. If you remember, I was talking about this 8,100 being in supplies as of the 11th of this month, but very likely we've used some of these supplies, right? What we're going to look at in adjusting entries is the fact that our supplies account, our asset of supplies, likely isn't $8,100 anymore, and we need to update this supplies account, this asset, to recognize the use of supplies so that our financial statements are 100% accurate and reliable. But again, that's something for next time, and I'll see you guys then. Thanks so much for watching. I hope you enjoyed, and if you did, hit that like button and please subscribe. It would help me out a lot, and it'll let you know when I post a new video. Thanks a lot. See you next time.